Yesterday, the Hawks were in control. Random selection of who got interviewed, but we're bringing in a dove now, Jim Bullard. He was one of the first to call for rate cuts, and you're still calling for rate cuts, although you want 25 basis points. You're not ready to do 50 this next time?
I think there'll be a robust debate about 50, so I think it's creeping onto the table here, but obviously the markets have it as a base case of 25 basis points.
Jay Powell characterized the rate cut on July 31st as a mid-course correction, but the markets are basically pricing it as the start of a rate cut cycle. How do you see it? How much accommodation does the economy need?
I like to think about the mid-90s examples, the 95 example and the 98 example, and I know some of your viewers weren't around paying attention to financial markets at that time, but if you look at that, the Fed adjusted, was worried about, let's say, the Asian currency crisis, very similar to today, lowered the policy rate by about 75 basis points. The U.S. economy actually powered through that whole episode, and then the committee took those insurance cuts away later. I think that's a great baseline idea about what we're looking at now with a global trade war, global manufacturing and contraction, and possible spillovers to the U.S. You want to insure the economy against that and stay out of trouble.
So you think maybe 75 basis points is where you would see us stopping at this point?
I'm saying that's what they did in the 90s. I don't know where we'll end up, but I do think that you've got this yield curve that's massively inverted here, and you got the funds rate as the very highest point on the whole yield curve. That doesn't make a lot of sense. So we have to react to the fact that there's been a downdraft in global yields.
What is it that you're insuring against? There doesn't seem to be a demand problem in the U.S. There doesn't seem to be a cost of credit problem in the U.S.
No, this is a global slowdown, and there's a trade war going on. I don't think there's resolution likely anytime soon. And this trade war is triggering other actions around the world, other countries thinking about reevaluating their own trade relationships. So this could easily get out of control and easily feed back to the U.S. That's not my base case, but it is something that could happen. I think we should protect against.
But how does monetary policy do that?
Well, lower rates will stimulate our economy somewhat compared to what they would be otherwise, and that would help us power through the waters, the churning waters here of the trade war.
A lot of people say lower rates won't help because the problem that we're having is companies cutting back because of trade war uncertainty, not because they think that the economy is going into a recession.
Yeah, but it's a big economy. There are lots of other aspects to the economy. Interest-sensitive sectors that are it's going to matter for them.
How much additional growth do you think you can provide to the economy?
Well, that's a great question, and there's a long literature. Much of it's been presented here at Jackson Hole over the years about what the real effects of monetary policy are and how much the economy reacts. But if you think about the 90s Asian currency crisis example, we actually argued in St. Louis during that period that because rates were lower because of the flight to safety, that helped the economy get through that episode with kind of unscathed. And so, maybe we can get an outcome like that this time around.
Well, how much of it is the fact, the idea that somebody will see lower interest rates and go buy a car, and how much of it is just reassuring people that somebody's watching out for the economy?
Well, we do want to continue the expansion, and we're certainly willing to take all actions that we need to continue the expansion as best we can.
How much do you worry about the way Wall Street sees it? The idea that they think there's a recession imminent and they're looking at 4 additional rate cuts. Do you think they're reading the economy and the outlook wrong?
Well, if you look at the yield curve, it's been a good predictor of slowdowns and recessions. And so if you have a recession prediction model, it's going to use the yield curve to try to predict that. So our job is to get the yield curve curve to be uninverted, so that those recession probability models don't work anymore. That would be a great thing to do. I'm not interested in testing somebody's theory about this time is different about the yield curve.
Well, do you think that with the haven trade these days, you might not be able to get long rates up because so much money's coming into the U.S. because rates are negative elsewhere?
Right, but there's a silver lining to that, because that's driving longer-term yields lower, and that should be helpful to the U.S. economy. That's what happened during the Asian currency crisis.
What are CEOs in your district telling you about what's happening, what they see happening?
Depends who you talk to. I would say in manufacturing, they're very much scrambling to reorient supply chains, think about new strategies that will work even in a more uncertain world. If you look at agriculture, that's very much a down industry, I would say, for now. They're very much affected by the trade war. So, but on the other hand, consumer goods or something more closely tied to U.S. consumer, they're doing pretty well. Walmart reported out of our district last week that very strong sales. So I think there are good things going on the consumer side and the household side, which makes perfect sense. You've got, a great labor market, unemployment near 50-year lows, a lot of good things going on in that dimension.
Well, business has been holding back on spending. Do CEOs tell you that they think there will be demand out there will be a reason to invest if they get past the uncertainty if trade wars go away?
I think they'd be willing to invest, but they're kind of wondering, oh, wait a minute, no, how should I do this given the uncertainty that's out there?
Do you worry that the Fed is the only game in town and that people are putting too much responsibility for keeping the economy afloat on you?
I do think all eyes have turned to central banking, but that's over the last decade, and I hope people are coming to the realization that you need other types of policies to help you. There are many, many policies pursued by federal and state governments, and it's the sum total of all those that help your economy.
Would you think that the economic situation in the U.S. now calls for a significant fiscal response?
We just got a budget deal through, and it is more spending. So I'd like to see an analysis of that on the economy before I go to another spending bill on top of that.
Inflation.
It was bipartisan too.
Yeah.
I think people say, well, there's never bipartisanship, but actually you got that through. So I thought that was pretty good. Yeah.
The minutes showed that there was division on the committee in terms of inflation, and some people thinking that cutting rates is one of the reasons for cutting rates is that inflation expectations have slipped and they're too low. I presume you're in that camp.
I'm very concerned, excuse me, about the 5-year TIPS break even, which is I'm not sure where it's trading today, but it's been trading very low. And if you subtract off 30 basis points to translate between CPI inflation and PCE inflation, it says that markets are only expecting about 1% or maybe 1.1% inflation over the next 5 years. And we're supposed to hit 2% inflation. So I think we can afford to be kind of dovish here, get those inflation expectations up, and hopefully hit our inflation target over the next 5 years.
Well, again, a question about what you can accomplish. Do you think you actually can move inflation expectations, given that you had rates at 0 for 7 years and inflation couldn't hit 2%?
Well, we have to try while we can, and while we're in the position to do so. I definitely think inflation expectations will move up if we play our cards right here.
How long do you think we need to be in a rate cutting cycle? As long as the trade wars are on?
I think the trade wars have been priced into markets in a way that they weren't earlier. I think as of May or April-May timeframe this year, markets were kind of putting, I'm making up numbers, but like 90% probability on the idea that there would be a deal with China. It was just around the corner, just 2 weeks away, something like that. Now, I think it's shifted the other way, where Wall Street is putting 90% probability on no deal anytime soon. The notion that maybe the Chinese will just wait for the election and see if they can get a new president to negotiate with. So I think all of that's now been priced in, and so there's probably no more kind of downside to that, at least.